Hello, listeners. Welcome back to the Jacob Shapiro podcast. Rob and I are back at it for our weekly chats. Rob has been very graceful with me as I've been all over the place the past couple of weeks. We got a short episode in here this week, and we will pick up our normal cadence as we go. Next week, if you have any questions, comments, concerns about anything you have heard on the podcast, you can email me at jacob@jacobshapiro.com. Otherwise, cheers and see you out. All right, listeners, Rob and I are back at it. We have a tight 40-minute episode today, which, Rob, don't let that stop you from referencing the English Civil War. I'm sure that we can do a podcast in 40 minutes and still talk about the English Civil War if you want. But Rob and I were just talking. It's been a minute since we even got to catch up because my schedule has been so berserk and is thankfully coming back down to earth. But why don't we just check in sort of at the top level, Rob? Because I think there's a lot of contradictory data and especially narratives out there right now. Like for instance, if you pull up Reuters this morning, like the four main things top of the fold for Reuters are the Trump auto tariffs, about surging corporate margins in the US for Q4, fewer jobless claims than expected, and consumer sentiment at a 12-year low, according to the Conference Board. Like, that's four very, very different stories. And I feel like, I mean, the media has never been very good at putting these things together, but it's like they're just throwing narratives at different things and trying to say, well, this is tariffs and this is politics and this is geopolitics and I don't know. So when you're looking at what you're seeing, like, which one of those stories, if any of them, are the one that you're focused on, or is there some other story that's happening entirely that we should be focused on?
Well, it's really hard to parse out the political agendas with every sort of spin on the news, because everyone has their own reasons for saying that this or that is happening. Like, the big narrative that I'm seeing emerge is that we're entering, a significant recession. And certainly, like, market participants are all kind of talking about that in the financial media. I'm not so sure. Definitely we're seeing growth slow down, but that's been going on for at least 12 months as these sort of cyclical areas of the economy, especially construction, areas around infrastructure, things like that, just slow down after a huge boom. But the notion that, like, the Trump tariffs are all of a sudden toppling us into some huge 2008 style crisis, like, that's just not supported by the data. I think you have to have a more nuanced view of what's going on. Really, like, we're in this slowdown. The question is, how bad is it getting? How bad is it going to be? But then again, against this backdrop, as you pointed out, you've had this strange, like, sudden bolus of inventory build. So in January, lots and lots of companies loaded up on inventories because they're anticipating tariffs. So you have sort of a growth bolus that appears to have happened, just in the last month or two. How much is that going to be sustained? Like, there's a lot of uncertainty and unknowns, but beware of the simple narratives, because the simple narratives just aren't right. As I mentioned to you before we started talking, like, what we're talking about internally, especially at Off Wall Street, which is, we're always looking for where's the death and destruction and where can things go wrong. Just picture, like, the James Bond Spectre meeting, we're all stroking our cats and, the short sellers in the shadows. But we're not talking about a big growth recession. We're talking about the risk of just volatility and uncertainty just constraining margins and constraining profits and making it very difficult to manage a business. And I think we forget you can have a profit recession without a growth recession. And people have sort of lost track of this because it hasn't really happened since the 1970s. But that's a very possible outcome here, and probably the most likely one. So I would take those narratives and just shift them a little bit. The uncertainty, the policy, stop, start, all of this stuff is definitely having a negative effect, but you can't use that playbook from 10 years ago and assume, it's a credit crisis or it's a big recession, because the data just doesn't support that.
Mm-hmm. What, for the average U.S. consumer, do they feel any difference in a profit recession versus a growth recession? Like, is it just sort of the same thing and a different term, or will it manifest in distinctly different ways?
Well, a profit recession isn't so bad for households necessarily. It depends on how bad inflation gets and how much wages keep up with that inflation. Because right now, like, despite everything, consumers are doing pretty well. Wages are good. Employment is pretty high. Asset values are still pretty high. Like that is the one leg of the economic stool that is still very much intact. And like if you look at the margin, like what are the people who are really deep in markets? What are they really focused on? Everyone's looking at these areas of consumer spending that have just been so resilient, like high-end services, high-end travel, cruise, hotels, like urban upper scale hotels, that sort of thing. And like little signs of that starting to roll over. Are people starting to freak out? Are they starting to worry? But for the most part, consumers have had it pretty good, except if you're, making like an omelet. Um, and,
Yeah.
you know, at the very high level, like a profit recession is bad for business, just by definition. Whether businesses then go and fire people or, there's after effects that are negative for consumers is a little more uncertain. But on its face, it's not necessarily bad for households. It's bad for people who own stocks. It's bad for people who own assets. It's bad for the business owners. That's for sure. But, the average blue collar worker, to the extent those people even exist anymore, all 12 million of them, they're not necessarily gonna get hit by that.
Mm-hmm. And how do you mentioned that the narrative on tariffs is sort of simplistic, and I wanted to ask how much of that is because Trump has threatened a lot on tariffs, but he hasn't actually followed through a lot of the time. Like we're already seeing this with quote unquote Liberation Day, where at first it was going to be this is the one, this is where we're going to pull out all the tariffs, and it's well actually no, like we're leaking that we don't want people to know that things are not going to be as bad as it's going to be. He announced the auto tariffs yesterday to great fanfare. They don't go into effect until April 3rd. We've seen that movie before where he announces something a week before time. Some people come to the court of Trump and bow and, say nice flattering things to him. And then he withdraws them such that like you really haven't had that big of an impact relative to the noise that's been generated. If he, for example, if he goes with auto tariffs and if he goes with 60% China tariffs and if he does the copper tariffs and all these things that are out there, does that change the narrative for you at all? Or is all that you think sort of baked in and priced in? I think it's been interesting to watch how China has basically been saying to the United States, we were ready for 60% tariffs. You haven't done anything. Like we're fine. Like if you want to talk about this, like we could talk about this, but like we're not even close to feeling the pain that you think that we're feeling. So how much of it is that? And how much of it is just that, like you said, it's that volatility, and it's not even really real volatility. It's just sort of the uncertainty that the White House is beaming out.
Well, there's two real impacts of what they've done, and it is sort of the Lucy with the football, method of policymaking. Um, you know, Putting the football down, tariffs are coming. Oh, pull the football away, and Charlie Brown falls on his face, right? So yeah, in real terms, like if you were an economist who was measuring things, not that much has changed. But if you're actually, a human who's talking to people and understanding how psychology plays into all this, it's had a huge effect. And really, that effect is twofold. The first is just in terms of planning and anticipating. Businesses all of a sudden are topsy-turvy. So for example, we just last week we had sort of an open chat with the CI Club, and one of the members who is working for a big industrial distribution company in the US pointed out, like, at the beginning of this year, like the uncertainty was so off the charts, and they have certain service level commitments they have to keep with their clients that are very high. And so they had to load up on inventories and make sure they had this stuff like well in advance because they don't know what's going to happen. So that's a real economic impact because, that's an investment impact. Investment is about looking into the future. This is going back to John Maynard Keynes. Like, can you anticipate the future? How much confidence do you have? Like, all of that stuff really matters. And this is like, everyone knows this. But the second and sort of more problematic thing is just the notion, like, you can't have the Lucy with the football, policymaking method for long before you just begin to sort of trickle out the feeling that these people just aren't serious people, that they just don't know what they're doing. And all of the stuff that happened, last week with the signal issues and that, like, all of this contributes to the growing fear and worry that like, oh my God, there's adolescents like running this thing, like people who are just not dependable, who say things that they don't mean, who say stupid things, who aren't thoughtful. And that factors into things in a very real way, both because like perceptions of stability, perceptions of institutional stability go down. So like right now, just to tie this into the real world, the Swiss National Bank just lowered interest rates to 25 basis points. And part of the reason for that is they're beginning to jaw and say, hey, don't you come and buy the Swissy too much because, you know, you're causing deflation in Switzerland. And the reason is because all of these clients, people who own wealth, are saying, holy shit, what is going on in the United States? We need to flee to safe haven currencies. And that's a big part of what we do at Bespoke. So, you know, we're kind of deeply intimate with this. But you're already seeing that implication, that follow through from perceptions of insecurity, perceptions of instability, and that's a real economic impact. So if you're, you know, we've talked about this a lot, how Trump's policy, his plan really depends on sort of instilling the confidence in American manufacturers and industrial companies to build capacity to do things domestically. But at the same time, even as he tries to support that on one hand, with the other hand, he undermines the confidence and the perception of, you know, stability that you would need in order to actually do that. So to put that in concrete terms, one area that I've been doing a lot of work in the last 2 months or last 2 weeks is on the solar side, like really understanding what's going on there. And there was a really interesting interview with an industry insider who does installations. And basically the consensus view among solar people is it's very unlikely that the IRA is going to get eliminated, but they're likely to do these domestic content requirements and make them more stringent, and they're likely to reduce the amount of time that you get. You know, this is a real risk. It's not sure that this is going to happen, but they may reduce it from 2032 to 2028, the period of time in which you get these extraordinary tax benefits, you know, for investing in this area. And the irony, as this person pointed out, was there's no domestic capacity to do this stuff. Like they're going to put these requirements in place, or they might. There's a risk. It's not sure yet, but we don't have the capacity to actually provide that. Like there's no supply. And then at the same time, they're reducing the time horizon to a point where no one would build a factory for that today, because by the time it comes on in 2028, it's done already. And there's no like, it's building your economic house on quicksand is essentially the takeaway from all of this.
Yeah. Which kind of segues into the other thing I wanted to pick your brain about, because, you know, one of the metals that is most exposed to the green transition and and solar and all these other things is copper. And gold has been in the news quite a bit, but copper is starting to make some headwaves too. So copper futures in New York hit a record high on Wednesday. So we're recording Thursday, so just yesterday. And there was also news, Bloomberg was reporting that President Trump might impose tariffs on copper imports in the coming weeks. It had been projected that that was going to be months out. Copper prices are up 30% this year. That actually outpaces gold, which is only up 16% on the year. It's also one of these critical minerals that people have been talking about in the context of, you know, commodity super cycle. You remember 2 years ago when everybody and their mom was talking about the commodity super cycle in this part of the world? Now nobody talks about it. But copper was the big one, the red metal, the one that we're going to need so much of, and the shift between Chinese construction to, you know, the greenification of the economy. Tell me what copper tells you in relation to this market, because I think you have a contrarian take here too.
Yeah, well, the consensus view, I think, is that this is all tariffs. So just at the level of Mr. Market, what is he telling you? Copper futures prices just hit a new all-time high. They just broke out just in the last month to a new all-time high. Just, you know, that's really important, and you should just stop and digest that for a moment. And if you look at the data around that, it doesn't appear that this is just like, oh, it's a tariff pull forward demand thing, and this is going to spike and then it's going to go down. Like the chart just doesn't look that way. The chart has been strong going back for some period of time, even before this was really on the radar screen, like back before Trump's election, things like that. Longer term copper prices have been moving pretty well in line with like 10-year treasury yields. So if you were to put a chart of those two things against each other, 10-year treasuries had been stubbornly high for the last several months, even as copper kind of pulled back. And now copper is merely catching up with 10 years. So 10 years aren't reflecting tariffs. The copper sort of futures contract curve doesn't look like it's just a ton of pull forward demand and then, prices collapse, once you get beyond the tariff period in terms of futures delivery. All of this suggests like this is a real breakout, and this isn't just some news headline fake out. Maybe the copper super cycle is just 2 years too early. I think that's probably the most likely explanation, because really, if you look on the supply side, like those issues haven't gotten any better. They're not going away. So, not to always harp on Mr. Market, but you really have to pay attention when Mr. Market is saying something and forget about these headlines and really focus on what are the underpinnings of that movement. It doesn't look sustainable, and I think it does.
The last thing I wanted to pick your brain about, because listeners, like really, I rely on my weekly conversations with Rob to make sure that I'm fluent in what's going on in markets. And I've been on the road so much the last couple of weeks, I haven't had a chance to actually download from you, Rob. I think one of the places where I think you and I have actually not disagreed, but are sort of seeing things differently. And this is a question I'm getting often, especially because I'm talking to manufacturers or commodity exporters in the United States, is where the US dollar is going. And I think you, and correct me if I'm wrong, I feel like you've been saying that you thought the dollar could weaken from here. And I'm looking at the situation and thinking, I think maybe the dollar is going to strengthen, because I think the more volatility there is in markets, the more there is a flight to relative safety and security. And for all of the things that are happening in the United States, the dollar is still that place of relative safety and security. And, barring some kind of, the Trump administration is talking about some kind of Mar-a-Lago Accord that's going to be like the Plaza Accord that's going to reduce the dollar. Like, to me, it sort of sounds like unicorns. But, barring some sort of major shift in that direction, it just seems to me like we're in a long uptrend for the dollar, and that there's no real reason for the dollar to retreat from here. So give me your latest on that, and tell me if you think I'm wrong, or if I'm missing something.
Well, I mean, I don't want to intellectualize this more than we need to, and everyone has their little dollar milkshake, different theories and stuff. I'm not interested in trying to do it at that level. I think you have to be very pragmatic about this. The dollar is not collapsing or anything. The question is what against are you measuring? And against that, the dollar has lost significant ground against the euro this year. The euro had been rolling over and then really rallied back into support. So it's back, around 1.08, which is fine. It's not I don't think it goes above 110. I don't think it goes near parity again. I think it stays here for a while. Again, everyone likes to philosophize about the dollar, but you really have to ask, what are you measuring it against? And if you want to think of flows of capital, well, then you have to look at what are the areas where the wealth matters. Where is their wealth? The wealth is in the United States. The wealth is in Europe. The wealth is in the Middle East, and the wealth is in China, Japan. Those are the places that matter. If the dollar appreciates against the Indonesian rupiah, I don't know, unless you happen to live in Indonesia, who gives a shit? It's not, no offense to those people, but they're just not moving the needle much in terms of overall pools of global wealth. So, Europe, I just described. Middle East is very similar. Japanese yen, all those guys already own US dollar denominated assets anyway. And the question is, what, if anything, could get them to repatriate? So there's kind of a one-way risk on that side of things. And then, you're really left talking about China, which is its own weird thing, because it's an issue of, it's not an open economy and stuff like that. So generally speaking, if you look at the fiscal trends in the US, those are all pointing very negative for the dollar. I think growth is, even though I just spent 10 minutes saying that we're not entering a big recession, a profits recession is not good for the dollar. Any turnaround in the extraordinary outperformance and overvaluation of U.S. risk assets relative to everything else in the world is not good for the dollar. So it's hard to see what is good for the dollar. So that's kind of my view. Like, we are actively encouraging people to diversify away from the dollar. Like, the dollar is not going to go up in smoke tomorrow. But if you're right about a multipolar world, like, this is what all the Trump administration's policies are about. They're trying to force through, even in kind of backhanded, unusual ways sometimes, a different role for the U.S. in that world. And you have to really think that's not going to be successful, or they're just going to stop trying, or everything's going to go back to the way it was. And you're just going to have, Taiwanese life insurers just channeling capital into the dollar again. Like, I think that world is over. So I don't know what people philosophize about the new world will be, but it's not going to be like the old one. And the old one, basically everything was in the dollar's favor. So that's my answer.
Yeah, that's a good one. I'm glad you brought up the unipolar world or the multipolar world, because I think that's a good thing to spend our last 20 minutes on, because I've been talking about multipolarity for a while, and the second Trump administration in particular, has certainly accelerated that trend. But you look out at some of the places that we're interested in a multipolar world, and it hasn't been a particularly good couple of weeks for them. For instance, in Brazil, you've got central bank talking about raising rates and worried about inflation. You've got Lula's popularity or approval ratings are starting to flag. So not an unambiguously good story there. Brazil, I think, is also sort of disproportionately exposed to the steel tariffs that the United States has been talking about. Indonesia, the situation not particularly positive. Prabowo is kind of living up to our worst fears of him, stacking the cabinet with his cronies, doing lots of populist spending, isolating capital, whether it's in this sovereign wealth fund that he's talking about, and then letting the military have a more active role in the Indonesian political sphere. They passed that law last week, so kind of a reversal of getting the military out of politics from their role from the 60s, 70s, 80s. Turkey has obviously been difficult. There's a lot of sort of at the grand strategic level, things are going well for Turkey, but we saw the Turkish central bank burn through something like, I think it was 79% of the foreign reserves they've accumulated over the past year just to defend the lira around the arrest of this Istanbul mayor. So we're talking about, the Turkish lira, again, not for reasons of fiscal or unorthodoxy like we were last time, but because of political interference by Erdogan. India has been more of a mixed story. They had a brief swoon in their markets, which the media extrapolated as sort of a downturn. Now they're up into the races again. I think one of the reasons they're up into the races is because food inflation has declined quite a bit in the last couple of months. If that went up again because of monsoon cycle or because of global ag trade, I think you could see a sharp turn there, because I think a lot of what's driving the Indian market is actually Indians themselves, although I'm curious if you would pick on that. And then the EU, it's still sort of too early to tell. I noted this week in my sort of weekly run through that, private sector in Germany expanded at the fastest pace that it has in 10 months. But this hasn't been a particularly fast 10 months. That's sort of a headline that's sort of poised to make you think that things are better than they are. And I think there probably has to be significant pain for Europe as they wander through some of these difficulties that they're going to get back. All of which is to say, like, the world out there is not looking so good, at least to me, from a market perspective today. Am I being too doom and gloom? Do you see that volatility? Are there strategies for how to play an international world when you go through some of these cycles where there are downturns, but you still want to be exposed internationally? I'll let you take that very open-ended question, whatever direction you want.
Well, I think you have to split this into two different spheres, because there's the geopolitical and the policy and the macro sphere, which is literally the pace of growth and the structure of policies and all the stuff that you spend all your time focusing on. And then there's the market side of things. So if you want to talk about equities, which in many of these cases, like Indonesia, like, it's a tiny market. It's almost not even worth talking about. But just in general, those two things are much less tethered than one might assume. Mm-hmm. So India is a very unique example, because that market actually has been on fire. That is a true, and you asked about domestic, like, it is absolutely being driven by domestic investors, and it absolutely is, it's a bubble. like a true bubble in the sense that valuation is just out and it's all about playing, for the next move. Like it hasn't gone exponential, but this is um, it's a mass experience that's going on in India. And, how long that lasts, I don't know. But we haven't spent any time looking at companies in India just because they're so damn expensive. Like you look at some of these things, you find some of these, sort of tech related companies are trading at 20, 25 times revenues. Like it's just nothing you would be interested in if you have any sort of discipline. And that'll turn around. So that'll, be more interesting in the future, I'm sure. But if you look like historically, getting to my broader point, there's a very low correlation between market returns and growth. So if you look at something like an Indonesia or Brazil, so much really depends on valuation and sentiment and things like that aren't necessarily tied to, you know, what we would be used to thinking of in the US as the drivers of equity market returns or stock market returns. So just it's important to distinguish between those two things because I think you can
Mm.
recognize that, oh, there's a lot of volatility. Like Indonesia, for instance, I think it's a great example. It's of those, it's the one that I have been reading about the most and really focused on, not because we have necessarily any real exposure there, but it is one of the more interesting potential growth areas in the future. Um, and yeah, I mean, it's highly uncertain. I would love to get your Indonesia guy back on the podcast and hear sort of the updated
Hmm.
view of what's going on there. Um, but from a markets perspective, so many of these things have been so bombed out, even when things were good, that you're really talking about value investing. You're really talking about, how does the sentiment shift? And I suspect that even if we're entering a period where, it's a multipolar world, the US watchdog is basically, kicked off for the night and everyone is it's like Lord of the Flies basically. um Mixing interesting metaphors here. uh but uh but even if we're entering a world where a lot of the shithead regimes are going to do bad things and there's going to be more volatility and bad policies being made, is not necessarily one that isn't going to be overwhelmed by the fact that these things are just so cheap in many cases relative to the US. And if you get a narrative moving in the right way, um, they could still be very good places to invest. Like the risks never went away. These are all risky countries and the valuations more than reflect that. So I don't know, like you don't need Brazil to turn into Switzerland to have a lot of success there. Um, I don't know. I'm pretty positive, even though I fully recognize all of this sort of news flow and potential issues and in the places that you mentioned. I guess that's the TLDR.
Okay, well, let's stick on two of them for a second. So let's stick on India. You were referencing the short selling meeting from earlier. So, as you guys are twirling your mustaches, you called it a bubble. Are you brave enough to start thinking about shorting the Indian market, or are the animal spirits too awake to allow you to indulge in that idea?
Well, again, I hate to be boring, but the boring answer is for almost anyone who's an investor or listening to this podcast, just don't try to short anything. Just don't short India. Like it's just not going to work for you and you're not going to be happy. It's extremely difficult to time these things. What is the catalyst? Like you always have to identify catalysts for these things to really break down. And usually in a bubble like situation, it's truly like a credit related catalyst because you end up going into the area of Ponzi finance and we're not quite there with India. Like it's just kind of chugging along. It's been for a long time. Valuations are off the charts. Like you could have said the same thing. I know obviously very different examples, but you could have said the same thing about Japan in 1982. And it was 5 years or 8 years before you really saw that bubble pop. So it's not recommended for good health and good sleep to try to short any of this stuff.
Hmm.
But I wouldn't be buying Indian companies right now unless you're finding some extremely off the beaten path opportunities.
Can you think of other examples in history where you had such a sudden influx of like retail investors driving up the value of a stock exchange? Like, is that like when you alluded to it, a bubble is that what happened in the 1920s in the United States? Was everybody and their mom just buying shares because it was the thing to do? I don't know how unique this transformation in the Indian market over the last 4 to 5 years is relative to other markets.
It's very classic. I mean, it's very difficult to compare because technology was just so different historically. Like you're really talking about like a 30-year period of modern technology. But the answer is yes. Almost every sort of bubble in history became a bubble because it brought in the rubes, essentially. And absolutely, that was the case in the 1920s in the US. It was the case in the 1720s in France with the South Sea bubble and the whole John Law kind of experience in the Mississippi bubble. Like these are classic kind of popular phenomena, and that's sort of what a bubble needs. Like a bubble does not happen with professional investors. Like they may participate and they may be all about it, but you need to have that belief come in and that sort of cynical nature. Like this is what people forget about bubbles is like bubbles are very rational. Bubbles are not irrational activities. And we like to think like, oh, bubbles are people are acting crazy and they're all drunk. No, it's not at all. Bubbles are very rational in the sense that if something is going up, exponentially, like people aren't blind to how risky these things are, but the potential upside simply provides enough risk reward that it's worth a gamble. And that's what drives bubbles. It's rational behavior, not irrational behavior, and rational behavior by new players who are not really usually the ones who are engaged. So yeah, it's always a popular phenomenon. India is the same thing. Like, I don't know how many people have talked to like Indian brokers, but everyone and their mom in India just opened up a brokerage account in the last 5 years. And that's great. Like, there's lots of positive after effects of that, but the simple fact is it's a popular phenomenon and it is in a sense a bubble because it's not based in fundamentals. It is based in a rational speculative wave. And the same thing in Japan you saw in the 70s. Like that was a very popular phenomenon. People I mean it's always the case. China in 2005, like it's always, the moms and the widows and everyone getting involved and your grandmother asking you at the dinner table, like what stock you're buying. Like that is inevitably the dynamic. And that's the case here too.
Yeah. You said you didn't want to intellectualize your dollar point of view too much. I'll at the risk of intellectualizing this conversation too, because you mentioned that you felt like Indian equities were overvalued, and I just who decides like what overvalued means? Like, is there any chance that overvalued will mean something different in the Indian market because there are all those people who have different priorities, and that they will just like set a market along different expectations than what like the U.S. market defined, like what professional investors in the U.S. defined as overvalued? Like, where did those ideas come from? Because they can't be like completely objective is the wrong word, but I would imagine that those sorts of like benchmarks are socially and culturally and politically informed. Does that question make sense, what I'm groping for there?
Yeah. I mean, what you're saying is, do you get a consensus that, hey, 20 times revenues, 100 times earnings, that's fine. And then that just becomes the new normal. Is that
Yeah,
the idea?
basically. Yeah.
Yeah. There's something to that because that's why these things can persist for a long time. Because if, like, just look now, you've seen an extraordinary change in the United States. Whereas if you were to go back to the late 1940s or the early 1950s, just the whole philosophy of valuation, the whole way that everyone thought about valuation was totally different. Like people focused on dividends, not earnings, because that was literally the money that was coming in your pocket from owning a stock. Was what was the yield that literally you would get cash sent to you in the mail. How much cash were you getting? That's how people thought about it because it was a very conservative way to think about it. And then over the decades, as like that value went up and up and up, and then people realized like, hey, the Great Depression isn't going to happen again, and people will pay up for something because you can kind of assume a longer term, stability of things. And, so there is some element of that, but there's a limit, right? Because at the same time, like there is an absolute standard of valuation. And I think what we saw in the 1940s, like when everyone was traumatized and like, oh my God, who would own a stock? Like that was the environment. Like that was the zeitgeist back then. It's so hard to imagine now. Like now everyone is just, drinking the stock market Kool-Aid. But that was probably an extreme in the other direction, but you do get extremes in the top direction, which are not sustainable because at the end of the day, there's an absolute value to things. And if you, and it's slightly different per person, but you have to think of like, what is the free cash flow of a business and what is that yield relative to the market cap? I just use a technical term that maybe people won't understand. Free cash flow is basically what is the cash profit of the business? And then what do they do with that cash profit? Like they may invest it back into the business. They may pay it out in dividends. They may buy back stock with it, like whatever. But that yield, like that, say it's a 9% free cash flow yield, like that is an anchor. That is a real number. And generally speaking, if you look at like how things grow, like ultimately this gets back to like how do things grow over time? Like what is compounding? Like you don't see things compound at 40% forever. Like the world just doesn't work that way. Like most things grow, like interest rates, if you go back 800 years have been like 4 to 8%, like medieval times, like whatever the changes, like that's just how things kind of grow, So there's this absolute anchor to valuation, which is always there, and it's relative to sort of interest rates and the rate of growth and reinvestment opportunities and stuff like that, where like it just can't stay higher than that for very long before like it just runs out of oxygen, because that's just the reality. Like people will always demand that. And other than that, like the cynicism can last for a certain amount of time, but then once it breaks down, where is the anchor? The anchor is only down there. So like in the Indian case, people may say, hey, people have been buying the stock for 50 times earnings, but if it's not growing, like at the end of the day, just the valuation is much less. And once the cynicism breaks down and sort of the understanding that, oh, I'll always be able to sell this to some other fool who will pay more. Once that breaks apart, the only thing that puts a floor in things is that sort of absolute standard of value. And that's ultimately where you end up going at some point.
Mm-hmm. All right, we've got 3 minutes before we got to get you out of here. So before I let you go, I want a vibe check on the ground in Paris. How is the Parisian street feeling about the United States, Donald Trump, the future of the EU, anything? Just tell me what the mood is like in Paris right now around geopolitics and markets and all these things we usually talk about.
The weather is beautiful. The sun is shining, which has not been the case for many months. Everyone is convinced that we're a bunch of fucking clowns and are kind of in disbelief as to what's going on. I think that's the quick and dirty. It's sort of not a crisis feeling, but certainly people are talking about world events from what I can see. They're focused on it and they're rubbing their eyes.
All right. Well, I know we got to get you out of here, so we will leave it there, and maybe we'll pick it up from there next time, because I want to hear more about the Parisians rubbing their eyes. Thank you so much for listening to the Jacob Shapiro podcast. The show is produced and edited by Jacob Smulian, and it's in many ways the Jacob Show. If you enjoyed today's episode, please don't forget to subscribe, rate, or leave a review. It takes just a couple seconds of your time, but it really helps us. Also share with a friend. If you're interested in learning more about hiring me to speak at your event, or if you want to learn more about the wealth management services that I offer through Bespoke or at Cognitive Investments, you can find more information at jacobshapiro.com. You can also write to me directly at jacob@jacobshapiro.com. I'm also on X for now with the handle Jacob Shap. That's Jacob, S-H-A-P, no dats, dashes, or anything else, but I'm not hard to find. See you out there.